Yep.
Good to see you, John. Welcome to The View. The big news on the domestic front is the stage 3 tax cuts and a forthcoming announcement expected today, tomorrow, from Prime Minister Albanese. What do you make of it all, John?
Well, let's remember we're recording this on Wednesday morning.
Yes.
And so interesting, he's going to announce what he's going to announce just before Australia Day, which is becoming a controversial day anyway. I think it's been clear in these videos, Paul, I've been saying for months, if not well over a year, I could not understand why the Labor Party did not want to look at the stage 3 tax arrangements and adjust them more appropriately to the current circumstances. The government's been saying over and over again, no, we went to the last election with that was our policy, and we're going to stick to our policy, which is fine. But what we've got to now is a reactionary change of some sort to the tax rates. Let's wait and see what they are. We can speculate. There's been speculation in the paper. But also the bigger issue is credibility of a government who says this is our policy, reiterates it dozens of times and then changes it. And it's a real concern to me, just as an Australian citizen, as a taxpayer, as someone who's building up their super fund, obviously therefore to our clients who we advise, and to the broader community. There's been a lot of planning going on. I know from my own point of view, trying to plan my personal circumstances at my age regarding what was said was going to be the new tax regime. And to pull the rug out from under that after 18 months of denying it is, to me, a real credibility issue and takes us into places where we don't want to go in terms of, can we trust anything that any politician ever says? Now, I know a lot of our viewers will say, no, you can't trust them, but it's about time we could, and we should. You can't have a situation where policies as significant as tax are flipped on their head at a moment's notice. There are good reasons to change the tax rates. I've been saying for years that I can't understand why we tax people who go to work at a much higher rate than people who don't. I think that it is quite stupid, the way the whole situation is. We disencourage people to work. We certainly hammer low-income earners, the people who do the jobs that most of us don't want to do, the lowly paid. Why they pay double tax in terms of income tax at a very low level, and then GST. Now, obviously, we're not going to adjust GST, but there is some black part of the politician's brain that don't understand that tax is more than income tax. There's consumption tax. And if someone earning $50,000 a year, Paul, $1,000 a week, living in Sydney or Melbourne, would absolutely be struggling to survive on that. And then he has to pay $6,000 or $7,000 of income tax, put a tax return in, and then he pays on everything he consumes other than essentials, GST. So his tax rate, I would argue, is probably towards 20-25%. Real tax paid, and which lowers his available cash for consumption. Now, that's being an issue which has been sitting in front of the Australian government for decades, and they've never addressed it. Piecemeal approach in 2008 by lifting the tax-free threshold, but it's remarkable that the tax-free threshold has not moved in 15 years, and I dare say if you compounded inflation, we'd be talking about 50% up. So,
John, there for a second. So you've commented about the political credibility, which I agree is an important issue. But from an economic standpoint, if we consider, the inflation that we've suffered over the last 12 months, the people on the lowest income who are spending a high proportion of their income on foods and basic necessities like rent and so on, have suffered the most. So from an economic point of view, and with the savings rate so low as it is at the moment, do you think that this is a positive, if the changes come through as we expect, is that a positive for the economy?
Well, it will be a positive, but think about it this way. I mean, I don't think I'm a genius, but I said this a year ago when inflation was rearing, clearly out of cost pressures coming out of energy markets, which were going to go into the broader economy, the cost of doing business. Wages catch up. We saw wages increase in July last year, the minimum wage, which no one criticised. But my point then was, why don't you give these people a tax cut so wages don't have to push up the cost of doing business, which in turn feeds inflation going forward. So this could have been stopped 9 months to a year ago if we had a Treasury who could see what was going to happen if we didn't move on the tax rates, and if the government didn't go back 30 or 40 years and look at history where you do agreements with wage earners who take a tax cut rather than seek a wage rise pre-tax. That's my opening remark. Everything else you've said is obviously correct going forward, but the reason we're in the position we are is because the government and Treasury are being so pathetic in terms of managing inflation in this country. We talked last week, Paul, about the driving of oil and gas production in America as a reaction to inflationary pressures in that economy, the cost of doing business, the cost of living. In Australia, we've had the same issue and we've ignored it, and we've embedded inflation in our system, which will take a couple of years to get out. America will be out of inflation 12 months ahead of Australia because we're being inactive. So what we're doing now is reacting to inflation. Okay, we have to do it because we didn't do what we should have done. Fine. Yes, it's going to be positive. I take your point. And as investors, we need to look through the issues here and say, well, this is going to put more dollars into the wage packets of people who are going to spend it. Low income earners don't save money. They spend everything they get. So when you give them a tax cut, the conversion to consumption is very, very fast and very quick, much more significant to high income earners.
Yeah, John, is one of the implications that interest rates stay higher for longer? And also, is that going to be good for the Australian dollar?
Let's not caught up in the rhetoric. Interest rates are still too low, so they're going to stay where they are. I won't use the word higher. I'm going to use the word they're going to stay where they are for longer. Inflation in Australia is still above the cash rate, okay? That's not the position in America. Okay, so what we've got to do, assuming interest rates stay where they are for 6 or 9 months, get the inflation rate down towards 3%, and then we can talk about interest rates coming down. Completely contrary to what's going on in America, where interest rates are nearly 2% above inflation. Much different situation. I don't buy this nonsense that this is a demand-driven inflation cycle. This is a cost-driven inflation cycle. And there's so few economists who have woken up to the point that inflation was triggered by the Ukraine war and the surge in energy prices around the world. You only got to look at graphs. And we may well publish my graph, which I published in First Links last week. You know, the oil price and the LNG prices have plummeted over the last 15 months. Everyone uses energies. Everyone consumes energy. Every business uses energy as an essential cost of their doing business. So it's been a cost-driven inflation cycle, which has then moved into what I call a cost push inflation, because what happens is wage earners go, well, my cost of living's gone up, I want a wage increase. You give them a wage increase to sustain their consumption, not to allow them to consume more than they can, to sustain it. So it's not a demand-driven inflation cycle. I'm sorry, it's total nonsense. Okay,
John, you referenced America. I had a look at the figures this morning. The S&P 500 is hitting record highs on a daily basis. It has in the last 3 closes. Each one's been a record. I looked at the figures this morning. The S&P 500 is up 22% for the year. And then I compared it to the All Ordinaries, which is basically flat for the year.
Yeah, well, the Australian share market is so slanted to banks and resources that, you know, it's not a fair comparison. But it tells you why you've got to diversify. Yeah. And whilst I've got a watch on the Australian dollar, you know, it was one of the strategic issues, you cannot be out of the international market, particularly the US market, at all, because over any 5 or 10 year period, it's going to sustain your return on equities by having that diversification. The Australian market's an income market, very much driven by franking, driven by dividends, which takes me right back to what I said opening. If the government can't give us a clear statement regarding franking and the franking rules and tax, we should all be on red alert, because broken promises lead to utter broken promises. If the Labor government does what it says, and I'm not disputing it, but it's done it in a very unfair fashion by telling everyone it wasn't going to do something and it's changing its rules. But I take your point, Paul. The American market has done very well last year. It recovered what it lost the previous year, so let's put it in context. It's now reaching new highs, okay? And I would suggest that's what we said 3 months ago, Paul. We said the outlook was a lot better. Once inflation's back was broken, once interest rates came down, once bond yields came down, the stock market had a tailwind. The question is that tailwind been overestimated in the movement in stock prices? Arguably, yes, the American market needs to take a breather, but there's momentum there. And there's other issues. There's other issues at play, Paul, which I'm happy to talk about. You've put out an interesting article this morning or this week on the Chinese economy and the stock market. The Chinese, there's obviously a flight of capital out of the Chinese stock market, and I think one of the beneficiaries is Japan, which has now reached 35-year highs or something, and also across Asian emerging markets. Now, and I think also the American market is a default market for international investors. It's getting its fair share of capital flows, which China is not getting because of its policy settings. So there's another reason as well, is that the American Federal Reserve in the last few weeks is restructuring its quantitative tightening program, where it releases its bonds back to the market, and all of a sudden it's dropped its forward estimate from 80 billion a month to 60 billion a month. So it's feeding liquidity into the American economy as well. So those who are on red alert in the bond market all of a sudden say, the Federal Reserve is much more management orientated to managing the bond yields, which they have to be given the level of government debt. So there's a whole lot of things at play, which obviously I'll have more to say when I walk around Australian Marsh and talk to our investors, but there's a lot of tailwinds developing for risk markets.
John, can I point you to a very interesting development this morning in one of those sectors that is completely out of favour, which is the REITs. And this morning there was an announcement by the BWP REIT, which is one of those investment vehicles that holds Bunnings properties, and it's doing a $3 billion merger with, I think it's called Newmark. The REIT sector's largely been out of favour for obvious reasons, particularly in office, but this is more retail and industrial property, or mainly retail. Is this a sector that, and is this merger proposal a sign of renewed interest?
Absolutely. I mean, the property sector, listed property market is like a wagging tail. It goes up too far in bull markets and it goes too far down in bear markets. And without being rude, there's too much influence by retail investors, not more so by the wholesale market. The big wholesale market really is indirect property, so a more stable investment philosophy. And listed property is really, into the domain of retail investors, pension fund investors, and probably income-focused investors. Now, I think we said 6 months ago we targeted listed property as a sector was oversold. Certainly would benefit from the tailwinds of recovery and growth and sustained growth in Australia in 2025. There was not a lot of property trading. There is still a mountain of capital looking to buy quality property in Australia. There's just not a lot available. Those who have it and are being forced to devalue it by accountants and auditors and all this sort of nonsense are not selling at these lower prices. Cash yields are being sustainable. So you've got cash yields being sustained, probably inflation adjusted upwards, but the value of the building has gone down. So it's just it's accounting treatment. That opens up the way for mergers and acquisitions, corporate activity. So I think you're right. I mean, that's at a significant, I'm reading here something like a 38 or 40% premium to the last sale price. Bunnings Trust substantially less geared than the Newmark Trust. So there's a benefit in lowering gearing. I'd say Newmark's done very well for its investors. That's a significant premium. They've said, look, we're probably slightly too highly geared. Interest rates we're rolling into at a higher rate. So there's probably a 1 + 1 = 3 and the market's done the rest. So well done. I think there's other deals to come. And I flagged the other issue. I think the industry fund sector of Australia I predict in the next 3 or 5 years they'll be very active in the listed property markets. I'll see there's better ways to investing in property by taking out some of these listed property funds and privatising them inside industry funds than having them listed on the stock market. That's just a bold prediction.
No, I completely agree with that, because there's that obvious arbitrage in the discount that these vehicles trade at on the listed market compared to the unlisted market, where they don't trade at a discount. They basically are at net asset value.
And I make this point, I know we're going to wind up, but one of the things we do in direct property, we have done, very hard to find decent property today because good stuff's not on the market, but a lot of our trusts pay monthly income. And it's still, I find it strange why the listed property sector can't meet the demands of the pension market and start paying monthly rentals to their investors. That would be something worth looking at, but do you see any of them doing it? Absolutely not. So it's about time the superannuation industry, in particular, went to these listed funds and said, "How about you start paying monthly income? That would probably get your funds trading at fair value, rather than this quarterly nonsense they go on with."
Well, John, we'll have to end it there. Always an interesting discussion, and happy Australia Day to everyone on Friday. And we'll see you next week.
Thank you. See ya.
Yes.